Hello learners, Leon here, and today I want to do something different. As you know, I've been a dividend stock investor for a while now, and I've been investing in general in equities for the last 2 years, and investing in general really for the last decade. I have a degree in accounting and finance, and today I want to go over a stock that I recently invested in, and we're going to do more of these videos as time goes on. Because that's something I'm interested in, and I do want to do some more stock analysis with you guys. Okay, so today we're going to look at a company called Medical Facilities Corporation, which I've recently just invested in about a month ago. And just today we'll go over their business model, a little bit about their history and overview. We're going to look at Yahoo Finance, look at their current price, and just look at some key statistics on Yahoo Finance. And in a future video, we're going to dive into their financial statements, because just looking at the key statistics, just looking at net income is not enough to determine whether or not this particular stock is a good stock to buy. Specifically, the net income number that is reported in the company's financial statements isn't actually representative of the health, the financial health of the actual business. So without further ado, let's begin. Medical Facilities Corporation, currently as I am recording this video on October 22nd, is trading at $7.93 Canadian. Just a little overview. The company was founded in 2004 in partnership with physicians. So this is a Canadian company headquartered in British Columbia, I believe, that owns surgical facilities in the United States. So their portfolio includes controlling interests, which means they own over 50% in 5 specialty surgical hospitals located in Arkansas, Indiana, Oklahoma, and South Dakota, and an ambulatory surgery center in California. Now, through a partnership that they have with Newer Health, they also own controlling interests in 7 ambulatory surgery centers located in Arkansas, Michigan, Missouri, and a whole bunch of other states. So their ownerships in healthcare facilities is pretty spread out across the United States of America. The specialty surgical hospitals offer a range of high volume, which means a lot of people go by, non-emergency surgical, imaging, diagnostic, and pain management procedures, and other ancillary services such as urgent care and occupational health. The ambulatory surgery centers perform scheduled outpatient surgical procedures with patient stays of less than 24 hours. So it's pretty obvious from this paragraph what kind of business they're in. Basically, they own surgical facilities that do surgeries for patients that need surgeries that are not of the emergency nature. So we're talking about probably soldier surgeries. We're talking about different types of joint surgeries, hip surgeries, and whatnot. And really, the business, the cash flow that comes in, their business model really depends on the insurer that is covering the person that is participating in the surgery, as well as the case mix and patient mix. So what sorts of surgeries are being done, and the complexity of the surgeries that are being done, when coupled with the drug and staffing requirements for those surgeries. All of those things come together to affect the corporation's profitability. All right. Medical Facilities' unique management philosophy focuses on efficiency and productivity of the facilities. Our physician partners have a personal interest and play an active role in daily management and the strategic direction of our facilities. So what this means is this is all physician owned. Okay, so the company owns a majority portion of the facilities, and the rest is owned by physician owners who practice there as well as take a cut of the profit. So the positive is that physicians have a vested interest. They are interested in the profitability of the facility that they work at, but at the same time, what that means is there's an arrangement that all the profits that the corporation makes will be paid out first and foremost to those physicians. And when we do look at the financial statements, that shows up as payments to what we call non-controlling interests. So people that have ownership in the corporation, but really don't have voting rights because they're just a minority shareholder. Okay? So we're going to dive right into some of the statistics and the historical performance of the stock. It's also under MFCSF on Seeking Alpha. So in fact, the stock just declared their October dividend. Right now, it pays a monthly, this is monthly dividend of 9.4, almost 9.4 cents per share. Keep in mind, its share price right now is at $7.94 as of this moment of recording, or 93 cents right there, which actually makes its dividend quite high. As we go into the key statistics, that's what we'll see. Something that you'll notice is that this will be the company's 187th consecutive dividend payment since inception, and they pay a monthly dividend. The company itself has been public since 2006, so 2006, 2016, 17, 18, 19. So I don't think the company has missed one single dividend, really, in the last 15 years. Now, the company, it's only raised its dividend once, but one thing you'll notice right here, I think immediately what you'll see is the company regularly has really been around the $18, right? Down here, it's 15. This was when like the mini correction happened in 2016, went back up to 21, went back down to 15. So it's really been in the 15 to 18 range for the longest time, right? Ever since 2013, really. But for one reason and another, it's right now at $7.94. In the last year, it's dropped over 65% from $17.63 right there to drop to under $7. I bought in at around $8, and right now it's at $7.94. You can see that this is a small cap company. It's got a market capitalization of about 250 million. Because it's a small cap company, it's not followed by that many analysts. There's definitely not a lot of news on it. Once in a while, a piece of news comes out. These are just transcripts. These are dividend announcements. So you can see there isn't really that much news on it. Not a lot of people are following this company at all. So without further ado, let's look at some of their key statistics. So we see the key statistics here. Obviously, 250 million market cap, PEG ratio. Let's look at some of there are a lot of numbers here. Let's just look at some of the numbers that I like to look at whenever I'm analyzing a company, just an initial look. Obviously, I like to look at the market cap because this is literally the price of the company right now. The market cap is the price of the share multiplied by the number of outstanding shares. So in theory, if I bought all the shares of the company that were outstanding, that is on the public market, I'd have to pay 250 million. In other words, if I had 250 million, I could buy out the company. In other words, the company itself right now is selling for $250 million on the stock market. Now, this is a very, very important number in my mind because this number will tell me whether or not the company is underpriced or overpriced when I calculate the value of the company. Another statistic that I look at is the price to book ratio, and I like to compare this with competitors. But in general, if I see a number between 0 and 5, it's kind of an indicator that it's underpriced. Again, I just like looking at it. I want to make sure that it's not 100. If it's like 100, maybe the company's over leveraged, it's in too much debt. And the way you calculate the price of book ratio is you take price and you divide it by the total assets minus the total liabilities a company has on its balance sheet. And so for this company specifically, oh look, it's gone up 2 cents. Yay. For this company specifically, the price to book ratio isn't really that important just because of the nature of its liabilities, and we'll take a look at that at a later time. So we're going to go down the first column here, return on assets, return on equity. At profit margins, operating margins, I tend not to look at these numbers just because I don't really trust the calculations on Yahoo Finance. I like to do my own calculations. So I just kind of skim these numbers, kind of make sure they're positive. Debt to equity. This is a really, really high number. When I first saw this number, 140, I was scared of the company, because what this essentially says is if debt is the amount of assets that creditors are entitled to, and equity are the amount of assets that owners are entitled to, this really says that the creditors basically own the company. And as an investor in equities, that as an owner, I don't like that. Current ratio, I don't really look at all, because the current ratio is calculated for a specific moment in time of the company, and it doesn't really say much. I like to look at the operating cash flow of the company, because this is the number directly taken from the income statement. And I also look at the levered cash flow. And my initial kind of benchmark, the first calculation that I do in my mind, is using this market capitalization and this levered free cash flow number. So basically what I do is I take this levered cash flow number and I divide it by 0.1 or 10%. I use 10% as the discount rate. It's kind of like a benchmark discount rate that I use. And it's actually a much higher discount rate than I should be using, because Warren Buffett uses the risk-free rate as his discount rate. Some other people use the long-term return of the S&P 500 as their discount rate, which is about 8%. But I use 10% just because of the margin of safety. I don't completely trust in my own accuracy, and so I like to bump that up and have a more conservative estimate. If I take the levered free cash flow, which is the free cash flow the company has after it pays its obligations, its interest, and all that, and I take that and I divide by 0.1, that's actually the calculation to calculate the present value of a perpetuity. And a perpetuity is an investment that pays you a cash flow every period indefinitely. And when I look at a business, that's how I actually view it. It's that a business is an asset that I'm paying for that will pay me back money over a period of time. Hopefully this period of time is over the long term. And this is also why I'm so interested in dividend stocks, is because if I buy a growth stock, the implication is that one day I'll sell it. And I don't want that because then I'd have to start timing the market and all that. Whereas dividend stocks, they pay me back a regular dividend over time. Now, one thing that you see here is the dividend yield. You'll see that the dividend yield is 14.37%, which is ridiculously high for a dividend stock. Now, it was high even before the stock dropped 67%. Before that, the dividend yield was still between 6 to 8%, which is still high. So this company pays out most of its earnings in the form of a dividend. So these are the reasons why I was so interested in this company. It's because of this high levered free cash flow when compared to a market cap of 250 million. In other words, what does that mean? If I divide this 45 million by 0.1, in other words, I multiply it by 10, and I have 460 million. Well, what does that mean? It means I can pay 250 million. If I was buying the whole business, I could pay 250 million today to guarantee a cash flow to myself of 460 million over the next 10 years. And I'd say that is a pretty good deal. That's a pretty good return on investment, if I don't say so myself. Okay, so that's kind of the implication. Now this isn't tried and true. It's just an indicator for me that, oh, I should look into this company. Same with the high dividend. But a high dividend, people look at the high dividend yield and they're like, oh my gosh, I'm going to make money from this. This high dividend yield shouldn't actually be such an important factor when you're trying to calculate whether or not you should invest in a company, because the company can decide to not pay dividends at any point in time. They don't have to pay you a dividend. All right, and just based on these few things that I've seen, this is enough reason for me to download all the financial statements of the company for the last 5 to 10 years so I can take a look at the company and really try to understand how they make money, whether or not they will continue to make money, and whether or not the stock is really trading at a favorable price, and really whether or not I should buy stock and whether or not there's something hidden within the financial reports, within the annual report, that I and investors should look out for. In fact, that's exactly what I just did. Hey, the stock is at $8 now. Woohoo, right? In fact, that's exactly what I just did. I've downloaded all the financial statements, and in a future video, we're going to look at the profitability and the quality of their balance sheet, of their assets and liabilities, quality of their cash flows, how the changes in the accounting rules have affected their reporting, and really going forward, what should an investor do and how can you analyze something like impairment of goodwill? What does that even mean? Okay, we'll dive into that in a future video. Hope you found this helpful. Hope you found this little introduction helpful. It certainly is how I look at stocks. And if you're interested in learning more about how I analyze stocks, and come just learn together with me on this journey as I try to become financially free using dividend stocks, using investments, please subscribe to my channel, like the video, show some love to the YouTube algorithm, and I look forward to seeing you next time.